The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
This is The Call. 10 stocks picked by you, 2 expert guests, all in the course of an hour. It is the 25th of February, a Friday, and I'm Nadine Blaney. Really good to be here with you. And I am very pleased to welcome into studio for the first time in a very long time my 2 guest hosts, Adam Dawes from Shaw Partners and Jun Bei Liu from Tribeca Investment Partners. Guys, it is so good to see you in
great,
studio.
Isn't it?
It absolutely is. We'll get a wide shot so we can actually see it. Boy, what a week it has been.
Ooh, incredible.
Earnings, Ukraine, Russia, volatility. Jun Bei, are you nursing wounds right now?
I wouldn't say nursing. I think it does make it quite exciting for you to be able to see some opportunities in some of those companies, right? I remember 2 months ago, I think we were all have to struggle to go high risk stock to get some return, risk reward. But now every quality company has been sold off so much, even though they have delivered really good results and things, and share price probably down 30-40%. Just seeing a lot of opportunities in the market at the moment. So it's certainly very exciting. But of course, the war and all of that certainly presents uncertainties and things, but look, it will blow over. Equity market always look past it very quickly.
Look, this is where we as advisors earn our stripes. Yeah, I rang like all day yesterday, was just talking to clients saying, don't panic, this is okay, we're going to see this, and using a couple of charts to show how markets are affected by historical wars and showing them how they really shouldn't be getting out here. This is the wrong time to be panicking. But my real uncertainty, and to Jun Bei's point, is if this goes for a week, I think the markets will be nice, it'll bounce and we'll be okay. If this drags on for a couple of weeks / months, that could then drag on that uncertainty, which means that it's going to be a little bit harder for us to sort of work our way through that. But at the moment, it's great, some fantastic opportunities. And I'm just looking at some good quality blue chips that have been belted. And even the tech stocks last night, and the NASDAQ up. And I've been buying tech stocks for the last week and just going, oh my goodness, no more. And then today it started to move. So
well, that brings us nicely to what's coming up in the program. So I'm not going to get too far into earnings season with you both now, because we will have the chance through some of these companies. Helius is on the list in the first half of the show, SG Fleet Group, Unity Group, Regis Resources, and Accent as well. And I think it's a nice lead into the stock of the day. And I picked this one, guys, because again, it really encapsulates the week. Tyro. So if you recall, its shares tanked after it reported lower transaction value growth and higher costs. It was down 26% on the day. So that was Monday. That was terrible for existing shareholders, right? But today, it's one of the best performers, being lifted as buyers come back into the tech space. It's up by 7.5%, roughly 8%. And even in the wake of that result, the brokers are mostly positive on the company. So, outperforms, buy recommendations, price targets ranging between $2.68 and $4.70. Though it must be said, most of those price targets were cut off the back of the results. So the question is, where to from here? Jun Bei, I'll start with you. I mean, it really is a story of, it just paints a picture of what this week has been. Oh, absolutely. I can name so many little businesses just like Tyro has been treated that way. And when the result was actually not too bad. So Tyro reported a good result, but of course the cost was a little bit higher than expected. And they do have price increase and all of these coming through. But of course most of their customers are cafes and restaurants, and they're yet to be fully open. So that will take some time for that to come through, and it will. So market disappointed on that. And also because it's a week, essentially, investors just sold all their unprofitable tech. Any unprofitable tech has been sold off meaningfully. And if you didn't meet expectations, investors don't even want to talk about it. So at this point, it represents great buying opportunity. Look, but do be mindful. You don't want your whole portfolio to be representing, those unprofitable tech. But this company does have very good market presence. It has a reopening play to its, its earnings, and it's growing really fast at the moment. So it will become profitable very, very quickly. And I think, at this price point, it's very little, there's no limited risk, but, it's just you de-risk significantly on that basis. So it's a buy.
It's a buy.
Would you be buying Tyro now?
Yeah, I'm going to go with, absolutely. I've always liked this story, and the market's sort of struggled to get its head around it.
Particularly recently, and it had that big outage this time last year, which has never really recovered from.
Yeah, and look, it's a fantastic business because it's just taking a clip every time you tap your card. It's in between you, the card, and the bank. It's the processing of that payment. And look, we're going to cashless society no matter what. Like it's going to happen. So yeah, I really like it. I think it's a great business. The market has struggled with it. Obviously, down 26% on is a fair big move.
Huge.
But I'm really comfortable, going forward because of that just cutting every time you tap your card. It's just got that revenue going forward. So really comfortable with it. So yeah, I'd stay with a buy as well.
So that is the stock of the day, Tyro. It's a buy, even as it sees it's recouping some of this week's losses, only at $1.59 at this stage of the game. Right, let's get to it. I know many of you out there are chomping at the bit to hear what these guys have to say about the companies you're interested in. And first cab off the rank, Helius, HLS is the ticker code. This one is for Finn. I'm going to start with you, Jun Bei. This is a company that reported this week. Again, we can talk about COVID impacts and the like.
Right. Yeah, that's right. Look, it's Helius is the one that has been a huge beneficiary of COVID, the pandemic, because they do a lot of testing, or the pathology. It's a key pathology division, has generated a significant amount of earning from COVID testing. However, so far, because now the testing has now been moved from actually you do it in the lab to the rapid test.
Yeah.
On that basis, you're already seeing the volume coming off. And next year, the main issue with Helius and the Sonic is that next year, both of them will see that division earning fall by 50%. Just very hard for market to digest, that kind of earnings fall. We all know it's going to fall, but it's just very hard for the share price to go higher on that basis. Helius is probably the better one compared to the likes of Sonic. It's just because it's got a bit of cost out, it's got a bit of improvement, self-improvement, so it'll do a little bit better than Sonic, and potentially there's a bit more capital management coming through in the next 12 months or so, but it's just very hard to see share price going anywhere. I will put it as a hold, just because it's defensive, its core business still doing fine. It's just that hard to see the share price rallying away, but it gives you pretty good dividend and returns.
Yeah, so it's just a bit uninteresting, I suppose, for Jun Bei. In this market, you can get other opportunities elsewhere. Is that how you see it?
Yeah, I mean, if I was going to go to this space, Sonic Healthcare would probably be my pick in this space. But then looking at it and understanding that pathology is definitely going to be lower than expected going forward, and combining that, the only thing that's really saving this business has a fantastic balance sheet. And that position, I think, is essential when you've got half of your business, or a portion of your business, looking down the barrel of sort of lower numbers. So for me, it is a hold as well, but I would pick Sonic Healthcare as one. Sonic has also come off fairly hard as well, so there is probably some support somewhere in there. Sonic pays a better dividend, so for clients in that healthcare space, that's probably something that they look forward to. But Helios has got a good balance sheet, so it's okay, but I still think there's more pain to come.
Yeah, actually, just on that basis, I think the whole healthcare sector is looking very attractive at the moment. So aside from Helios and Sonic, were the clear beneficiary of it, the likes of Cochlear or CSL, they actually earning have been impacted by COVID-related lockdown and things, because elective surgery and other things, and blood collection and things. So both of them are looking at significant growth, on top of the normal structural growth they have over the next 12 to 18 months. And the share price actually have been sold off significantly since January. Cochlear had a bit of rebound. CSL had a really good result, a small rebound, but still way below what they were before. So, I think the healthcare sector represents a great buying opportunity relative to the tech, because they're the structural leader. When the bond yield stabilizes, that sector will outperform.
Yeah, definitely. And Cochlear actually reported quite well.
Really good result.
Yeah, I thought that was a really good result.
Same as CSL, really good result.
Well, obviously minus the acquisition, it was an upgrade. But the market sort of didn't see that. They sort of, it was the headline numbers were a little bit skinny, but if you took out that acquisition, it was definitely a beat. So I really like it.
Yeah, they're both very good.
I'm just in heaven having both of these people in the studio today. Keep it going amongst yourselves. I'll just move us along when we need to.
Perfect. All right.
We'll get to SG Fleet. SGF is the ticker code, and this one is for John. Let's start with you for a change, Adam.
Done. All right. So obviously this one, cars basically. Yeah.
I mean, it's been a thematic again of the pandemic.
Yep. And financial highlights, they reported 16% net profit after tax, which was, I think, a decent beat for this. And underlying EPS growth obviously continued as well, up sort of 23.5%. So really, really comfortable with it. Used vehicles, it still remains exceptionally strong. Now, we remember all of the talking heads on TV were talking about how last year it was all transitory. Yeah, this inflation's not going to happen and cars are going to get back to normal. They haven't.
It's
right?
just transitory a bit longer.
Okay, all right. So we're transitory for a couple more months. Second-hand cars looking very, very good. New car supply, obviously, order pipelines continues to be slow, and that's I guess going forward as well. Look, I think this is a buy. It's very undemanding where it is at the moment. I think it beat most people's forecast by about 10%. I would say buy beware. It is very, very thinly traded. So be really cautious on this one. I think I looked at the bid and offer. There's literally one bid and 3 sellers. So it's a little bit scary because of that low liquidity. But I think if you understand the business and understand the car market, I think we're going to be in for another year of these higher prices, and that's just going to translate to better share prices. So I'm comfortable with this one.
Would you go as far as a buy? I know that Macquarie hasn't outperformed, Morgan Stanley has an overweight, but I think that point about liquidity is pretty good as well.
Yeah, look, I think it's a buy. It's cheap enough. It's on 11 times earnings. It's really cheap, and then it gives a good dividend yield, 6%. Earning actually has been tough because of the cars and things, so that just means the growth for the next few years looks pretty good. Do be mindful, this sector never trades on a huge premium to the market because there's regulatory risk, right? So if the government came out and said, salary packaging, cars and things, it's gone. So, and this was discussed maybe 10 years ago, 5-10 years ago.
Shakespeare.
Yeah, and it's gone. Yeah, that's right. Yeah.
We all remember that one.
Yeah, that's right. So, but that's why they never trade more than 15 times. So 11 times is pretty cheap at the moment.
Okay, that's a buy. That's going in the portfolio as well. In fact, I'll detail the portfolio in just a moment, but it's not going immediately into the portfolio. These guys are acting as the first filter, essentially. So if it gets 2 buys, it will be put in front of our investment committee. More on that
Which
later.
Jun Bei's on?
No.
All right, then.
We'll cut that out. All right, let's go to the next one on the list, Unity Group. For Raymond. Now he says, he's giving a bit of context because of course this did report this week as well. He says it seems to have a solid business model, share price has come down. Is it time to buy or are there more falls to come? Now, it's a really interesting company. It has done so well since listing. It's an infrastructure play in most people's eyes. And the company's been very transparent in terms of a lot of the disclosure, saying that there have been people sniffing around, groups sniffing around. What was disappointing about this result? Or was it again a function of the timing and the place that we're at in markets?
Yeah, look, I think the result was pretty good. It just happened to be during this week of sell-off of all the expensive companies, to be honest. And I think this is definitely a stock to buy on any pullback, and at the moment represent really good buying opportunity. It is very defensive. It generates, good growth and. Potentially, further down the track, you'll get bought out by private equity. But that's, we don't know, can't invest based on that thesis. But it looks pretty good. It's a buy.
And would it have been a buy before this week, before the share price?
Look, I think this is just something especially for a portfolio, you want a bit of, on the small cap tilt. It represents a very good, bottom drawer type of stock. Gives you good growth, very defensive, infrastructure-like type of earnings. It just ticks a lot of boxes. And with that type of stock, you're always like, when do you buy? Because they just progressively move higher. So whenever there's a pullback coming through, it's represent a really good buying opportunity. It's a bit like, how NextDC is treated in that similar bucket in the large cap space.
They reported well.
Yeah, they reported really well. Yeah,
yeah,
absolutely. So yeah.
Unity Group?
I'm not so much on the train of the buy. I'm going to stay a hold for this one, only because they really didn't come out to the market and say they're going to beat guidance. They basically said they're on track. And I think, for these kind of companies that you want to see that them to really sort of go out and say, look, yeah, we're going to beat earnings. And I think the market would have then attributed to get some more buying into the share price. Notwithstanding that, obviously, COVID construction impact was certainly there for this business. And obviously, recurring revenue was good as well. CapEx has obviously increased by about 22%. So I was a little bit concerned about sort of more money going in. But overall, it's a good little business. But yeah, I look at that chart, you sort of see that around that $3.30 looks like a bit of support, but I'd like to see it trade a little bit sideways, to get form a base before I would do it. So I'd be a hold on this one.
But I mean, you didn't like that it didn't beat on guidance, but would you rather have a company, and this comes up a lot in reporting season, I'll ask the same question of you in a moment, Jun Bei, would you rather have a company that's a bit conservative, that maybe under-promises to then over-deliver?
Yeah, I mean, like Macquarie does a classic example of that. They always promise, but then over-deliver when it comes to the actual result. I think with these smaller companies, it isn't the size of Macquarie, but some of these smaller companies, I think I would really like them to come out and say we're going to beat guidance. We're ahead of our forecasts, and I think that makes the market sit up a little bit. Just saying that we're going to on track to achieve EBITDA, I just sort of feel that there's not much zing in the company. So that's why I'd be a hold.
He likes a little bit of pow, Jun Bei, in his statements. What do you think?
Long term, focus on long term.
Long term, all right.
So it's always a challenge for the company management to keep the analyst expectations down. At the same time, trying to give some sort of guidance on what's happening so far and a little bit of positivity. So if a company always beat guidance, the analysts naturally will go above their guidance. So I think this group of this management, they manage it quite well, and then over the year, over the reporting period, then they will start, getting those upgrades coming through. And if they consistently do that, it does provide a lot of comfort to investors, knowing at least he won't miss that guidance, right? So, which is very important. Yeah.
Unity Group. So it is a buy from Jun Bei. It's a hold from Adam Dawes. Let's get to Regis Resources, RRL. It again reported. This is for Helen. Hi, Helen. And just keep in mind, everyone out there, that this is information only. This is not financial advice, and it's not tailored to your own personal situation. So there you go. But gold is such an interesting area of the market right now, considering the macroeconomic and geopolitical backdrop. But you've got to choose wisely in this space. Is Regis one for you?
No, I would stick to the big boys, so the likes of Northern Star, it's just like you said, gold is a tricky place, and then all these businesses' share price will move with the gold price, and right now it's very high at the moment because of the uncertainty. But if once market move on from that current geopolitical issue, the gold will be sold off because inflation is picking up, growth is picking up. Generally, gold don't sit very well in that basket. So just be mindful of that. But within the group, we'd like the larger names such as Northern Star.
But do you think, Jun Bei, now is the time to have some gold in the portfolio? Does gold have to be in a portfolio?
Well, I think it's as part of portfolio construction, people tend to have either gold or the likes of bonds or fixed income in that, because it's defensive. Now the gold has lost a bit of its luster over the last few years, or probably last 12 months with the rise of cryptocurrency.
Absolutely.
So the Bitcoin has become the new gold, but obviously Bitcoin has represented a significant amount of volatility. I think something like 3 times the volatility of share market. You think share market is volatile, that's 3 times more. So it's very volatile. So I think gold will have its place in the portfolio, but it's not something, it's not easy to call where the gold price is going. People tend to draw straight lines, whether it's up or down. At this point, you certainly feel it has a big spike, and it's harder to see where it's after that spike.
Especially because we've got rising interest rates and everything else. Now, Adam.
So with the backdrop of rising interest rates and higher inflation, traditionally gold has been the hedge against all of that, right? So why hasn't the gold price moved, or why hasn't that happened? I mean, that's the issue with that. I generally, in my portfolio construction, 5% of clients' portfolio goes in gold, but it's not in the individual gold stocks, it's in the ETF, GOLD, right? Because with all of these stocks, you've basically got a lot of risk that management can't make it work. There's all this other stuff, whereas the commodity is the commodity, and that is moving with the overall commodity price. So for me, yes, I need to have some gold in the portfolio. I prefer Northern Star, absolutely is the number 1 pick, and then Newcrest for other people. Regis is a really interesting business because Regis is one of those businesses that has a lot of dirt to get a small amount of gold. Okay, so it's not a porphyry, but it is in that area where they need to move lots of dirt to get it. So they're all in sustaining cost, which isn't too bad, but it is a little bit high, is around $1,500 an ounce. Now that's in Aussie dollars. I think the Aussie gold price is 2,800, something like that at the moment. So look, they're still making, let's say, $1,000 to $1,300 an ounce, and they're expected on a forecast of around 420 to 475,000 ounces of gold. So do the math, it looks pretty good. However, having to move a lot of that dirt does cost them a lot of money, and they didn't declare a dividend. So it's got to believe, I think that you got to make sure that you got to pick the right gold stock in that sector. This one for me is not, so it would be a no.
It's
from
a
me.
no, so it's an avoid, and that chart didn't look crash hot either.
Yeah.
All right, let's get into a company that, again, may tell a story because, of course, it's in the retail space. We know what's been happening with retail. This is Accent Group and AX1, and this is for Helen. I don't know if it's the same Helen. If so, lucky days for you, Helen. But Accent Group, it's got a lot of shoe retailers in it.
Athlete's Foot.
Yeah, Athlete's Foot. And for me, it wasn't one of those companies that necessarily was, like a Kogan or an Adairs through the pandemic. So do we treat Accent a little bit differently in terms of talking about the cycling of those pandemic comps, Jun Bei?
Yeah, absolutely. Because with shoes, normally you do have to have the store open.
Yeah.
People try them out and all of that. So because the store was shut for quite a long period of time, so their earning absolutely has been hurt by that. I think with the reopening, this stock will do better. And the recent report, looks okay. I think in terms of trading result, like for like, I think in the first 4 weeks has improved significantly from down 20% in the first half. So it's getting better. It's a reopening stock. It's not that expensive. It's 14 times 23. We do have to look into next year because earnings yet to fully recover. I think it looks cheap enough for a retailer to do well, and it's a very reputable brand and things. So I will put a buy on this one.
Buy, and they're also looking to open another 20 stores, so increasing the footprint. I had to do that.
Well, you stole all my data, Jen. I got nothing. But look, store rollout is key for retail, and you have to keeping that footprint going. And they just bought Glue last year, which is a big sneaker brand, and those kinds of things. So I think that it is good. And Jun Bei picked it out absolutely correctly. They did miss a little bit on that net profit. It was down about 6%. So it was a bit softer going forward. Store rollout's definitely going to happen. But, I looked at this when I was getting the kids school shoes, right? So we went to Athlete's Foot because don't go to Clark's because it's really horrible for their feet. But now Athlete's Foot have got these fantastic shoes that look like school shoes, but they're sneakers. And the place was packed. It was just people everywhere.
I hate school shopping, back to school shopping. You always leave it
You've
till
got to go there
last
a bit
minute.
earlier.
Well, see, I'm just not that organised, all right? You might be. So, so I was looking at going, wow, this is amazing. Like, they must be killing it. So I think, looking at, and school's only for that sort of January, then it sort of rolls off. But for me, apparel is tough. Reopening trade, I agree, but I'm going to stay with a hold on this one. I don't think it is really demanding enough, and I think with the miss on the net on the NPAT, I think we would be. Yeah, it'd be a little bit hard for me to go on and step into this one just at the moment.
Cautious. Okay. Was there any retailer that we've heard from already that you thought is
Lovisa?
looking good? Lovisa yesterday.
I was going to say that.
Killed it.
That will be the best reopening trade. It's more expensive, but it's got a huge global footprint.
Yeah.
And it's not only it's the reopening of the store, it's actually because people stop buying the events that's going to pick up.
Yeah.
An event's going to be on constantly once the world reopens, right?
So that's a bonus pick.
That's
a
pick.
bonus buy from
The
both.
other buy for both of us. The other one that was a little bit disappointing was City Chic.
Yeah, that was really treated harshly yesterday as well. And it did very well through the pandemic. Was it a build-up in inventories that people didn't like?
I didn't really see. I
think that's a big one.
See.
Yeah, that's a big build-up in inventory. People said, but most of the retailers are building inventory because they don't know how far, they want to be able to supply demand. I think that stock is a very expensive stock, so it tend to trade at more expensive. I think it's probably similar to Lovisa, I think, in terms of multiple. So it has big expectations. So when you miss a little bit, so people sort of sell it off. And it has performed quite well, like
That's been
before
great.
So I think that's a really good company. It's in that niche. Actually, it's not niche anymore. It's becoming mainstream.
Pretty much.
Yeah, every brand now has this plus size type of.
Well, maybe that's why there's a bit of a miss, because when they first came out, they were one of the only plus size, and then now every brand's got.
Well, and they've done acquisitions. They've bought, in the UK, also in the US. So one that we'll be watching. But Lovisa would be the bonus buy in the retail space.
Definitely.
Oh, well, this is fun, and we're already halfway. So let me just take you through the first 5 stocks and the stock of the day, which was Tyro. It's a buy. There's value in Tyro now. But besides that, both of my guests do believe that it's a good business and that it offers a reopening trade as well. So great buying opportunity in Jun Bei's words when it comes to Tyro. Helius for Finn. Look, they think it's a good business. It's obviously done well through the pandemic, but it's what comes next. So pathology will likely retreat. And Jun Bei just questions whether you're going to see the share price rally. She doesn't think that it will. So it's got a place. It's a defensive stock. It's a hold from both of my guests. But look, Adam likes Sonic better, and Jun Bei was pretty impressed with Cochlear and CSL and their results, and also the pullback that we've seen in the share price as well. SG Fleet, it's a buy from both of my guests. Jun Bei says it's cheap. It's got a dividend yield. Adam just cautions that it's a bit illiquid, so very thinly traded. Be careful of that. Unity Group, it's a buy for Jun Bei because it's a good company. It's got good growth coming. Adam was not as impressed. He says that he likes these companies to beat their guidance. Jun Bei says you might see upgrades through the year. Regis Resources, it's a no from both of my guests. They would both prefer to be in Northern Star, so stick with the big players if you have gold in your portfolio. And Accent Group, it is a buy from Jun Bei because it's not expensive, it's not challenging, it's reopening, it's increasing its store footprint, should go well from here. It's a hold from Adam again. He was disappointed with that NPAT disappointment, but both would buy Lovisa, even after yesterday's share price gain. So there you go. Got a bit excited around the chat, sir, about Lovisa. Okay, so you know that we've been tracking a portfolio since July 1st of last year. Let's see how we've been going. Over the week, down by 5.3%, month 5.8%, year to date. So from July 1st, 2021, we're about 2.5% higher. But since its inception, which was July 1st, 2020, we're up by 31.5%, let's call it that, percent. So I alluded to the new portfolio. I'm sure you've heard David Koshi speaking of it as well. So we are going to be essentially running it like a live fund. So very small basket of stocks, high conviction. And so only about 10 or 11 will be in there. We will still use our requests coming from you and, of course, our guests on the day if they give it a buy, hold, sell. And that's essentially going to be the first filter. And those companies will go before an investment committee. That committee will meet monthly. They will then decide whether to add or remove stocks from the fund in favor of the ones that have passed the filter, determined on the day. And they can also include changing weightings, perhaps. They could include keeping a component of cash in there. It's all going to be a bit of interest, a bit of insight into how the experts really think about portfolio construction. So every month we'll have an extra edition of The Call. We'll take you inside the investment committee's meeting, so you'll see how the fund is tweaked, what they talk about, what's front of mind, and we might bring in CEOs if we see fit. Look, it's going to be really instructive. So in the meantime, keep sending your requests. We obviously are going to keep doing the show, and we will unveil the initial fund next week. Looking forward to that. Let's get back to the next 5 stocks. So we will be talking about Pexa, Pilbara Minerals, Jumbo Interactive, Stockland, and Worley. If these are any of your picks, that's what's coming up. Let's start with Pexa Group. This is for Reese. PXA is the ticker code, reported yesterday. The interview with the CEO is up on the website now if you'd like to take a listen. But guys, do we need to talk a lot about Pexa? Because, of course, end of an era. Really, it's not going to be listed for much longer.
Really?
Yeah, really?
Really?
Oh, okay. That's Link.
Link.
Yeah, you're talking about Link.
Link.
Right.
I'm sorry,
But-
Pexa. That was the day before we spoke with Pexa. It's been a big week.
Yeah.
Sorry, Pexa property, go. Save me.
Actually,
Go,
I was thinking.
go.
I was just thinking. Why? Since you said the Link, I was just actually thinking. There's speculation that the
Yes.
reason the bidder for Link.
Yeah.
Well, that bidder potential. They actually have a very similar business to actual Pexa.
Pexa.
So there was speculation whether they actually just want to get, the reason they're buying Link is because they want to get their hands on the stake.
Competition.
They want to get the stake in Pexa.
Right.
So in turn, it's actually potential bidder for Pexa in the future. So that's just speculation.
I love that Jun Bei is being very kind to me today.
Potential, yeah.
Would you be investing in Pexa, given all that background and knowing what's going on in the market here and overseas?
Yeah, Pexa is a buy. It's a significant opportunity in the overseas market to replicate Australian business. It's pretty mature in Australia, but obviously housing is going through a really good cycle, so you get listings up, volume and stuff going up. But it's pretty mature. It's really you buying for the future. And UK, they've completed quite a few. UK is going through its early stage of digitization of its property registrations things, and like Australia many years ago. And that market is going to be enormous. And and Pexa has already done quite a few testings, and then they got a couple of guys already signed up to start in 6 months or so. And that market is going to be enormous, and then they can go to other markets and the like. So I think that's absolutely a buy.
Yeah, it ticks all the boxes as well, because 38% beat on EBITDA, 45% beat on net profit after tax. So yes, that is absolutely what you want to see out of a company, beating guidance and then coming to the market. So yeah, absolutely, it's a buy from me. Jun Bei is exactly right. The UK momentum is going to be the key driver or the value driver going forward. The Australian market is skewed to the upside of the second half of this year, so we've just got to be a little bit mindful of that. But overall, guidance appears to be conservative, but then they've come out and beat this year as well. So really comfortable with that one. It's a buy from me.
And we're going to be seeing these volumes coming through in terms of listings, and that's just good for the business.
Oh, absolutely. And obviously, housing market, you've got to be a little bit cautious of. We are a mature market, but then, it's the UK, but then it could be the US, and then there's a huge computer share. It's gone through and just changed the way people do business, and I think Pexa can do that as well.
So you might not know, but is there anything like this being used in the US?
Oh, I think there is a few, but it's very fragmented, and then they're still very early on, like in terms of the journey. I don't think they have mandated digitization like what UK is going through at the moment, because the easiest is government say, look, you have to digitize everything, and then it goes through. US doesn't have anything like it yet.
All right, so that is a one to watch, and for international expansion as well, it's a buy. We are on a roll. Pilbara Minerals, PLS, for Patrick. Hi, Patrick. And we had the report coming through this week. Everything going so well in terms of the lithium price. They're digging it up. They're sending it overseas. The MD is stepping down, Ken Brinston. We're actually speaking with him later today if anybody's interested. Is Pilbara a buy, or have the good gains been made?
I'm actually just wondering what is he going to say.
I really want to ask. You can ask him why. He said basically end of 2022. So he's not just gone. He's
been there for I think 6 years.
7 years. So so absolutely, we'll probably buy 7 years by the end of this year. So I think he's right to be able to say, look, I'm moving on. But you've got a fantastic business. The stock price has done really well. It's in a fantastic sector, forward-facing commodity. I mean, look at that chart. It's just So why are you going? Like, what is the real reason? Now, he could say family reasons, health reasons, which is what they usually say. But I think you need to really sort of deep dive, because I always do get worried when you've got these large companies, when a CEO or CFO just sort of decides to leave. There's probably something that's underneath the surface that we just don't know about.
Well,
a little bit cautious.
Yeah. So what is that like for mining companies, Jun Bei? Because one would presume that, they're digging it up, shipping it out.
Pretty easy.
Signing off-take agreements. I mean, is there sort of key person risk with some of these miners?
Look, they found the business, then they tend to know, how hard it is to dig it out. I think that's a challenge. And for PLS, recently they have had quite a few production downgrades. And the result is actually really disappointing, because they just downgraded a month ago. Now they came out with another downgrade, and then now the CEO said he's going. So it certainly smells, it feels like something's not right. But look, these things that they're not really mining just in Australia or anything, so which is lower risk. They're mining around the world, so it's much higher risk. So you will have those production issues, a bit like Mineral Resources had a couple of production issues, and I do think they have a good asset. With the CEO going away, I do think this business eventually will get taken out. I think lithium is a place where you do want to buy those miners on the pullback. Share price done really well, but more recently pulled back quite significantly. I think you do want to buy one of them, whether it's IGO, whether it's this one, or the Orocobre, the other one. You got to buy one of them. IGO is the most lowest risk one, and it's probably the best asset and the like. But the challenge is they're bidding for something else. So they all have their problems, but IGO is probably a more defensive play in that space, and PLS is a high risk play for you to get exposure to to the lithium prices.
It's the sort of the cockroach theory. You see one cockroach in your kitchen, there's plenty of other ones that you can't see, and I think that's sort of where we are with the CEO departure. It does overshadow their earnings because their earnings it was a miss, weaker on higher exploration costs and finance costs, which meant the market has to trim their guidance and trim the expectation of it. So, look, what did you say? Did you say it was a buy or a hold? You don't think we've said anything, have we?
Look, it's a speculative buy.
Okay, specky, but you'd still prefer IGO.
So Adam has based his recommendation.
No, not at all. I prefer IGO as well because Western WSA is going to be all folded in, and that's going to be a fantastic business. Nickel, lithium, that kind of stuff. So IGO is definitely. I'd like to see this share. I think this share price is going to go lower. I think that we will potentially get something. Potentially, if you could get something sub $1, something around there, maybe sort of low twos. I think that's probably where this one on the charts had a fantastic run. I think it needs to find some support. That's when I'd be doing it. So I'm taking a hold on that one.
He went his own way anyway. Imitation is the finest form of
Well, absolutely. I'm amongst some. Anyway, I'll leave it alone. Yeah, next one.
I do want to make a comment about the cockroach. When I see a cockroach in the kitchen, I assume it did come from outside. I don't think it's just in front of my kitchen.
There's a lot more underneath. You just can't see them.
Oh, the size of cockroaches where I live, it just really astounds me. Okay, Jumbo Interactive is next on the list. JIN is the ticker code for Izzy. Look, Jumbo Interactive, what do you make of the business? It has also reported, I note that Morgan's has an ad, Morgan Stanley overweight, UBS is neutral. Where do you see the real potential for growth coming through here, Jun Bei, if at all?
Look, they've done a really good job leveraging their reselling agreement for Tabcorp, and then they got offshore expansion opportunity. I think the problem with this company is, they have agreement rolling off soon. I think that's in 1 year or 2 years. So they do need to plug that earning hole, and they do need to grow those offshore earnings. And I think the stock is probably just a little bit too expensive. At the moment, when it falls a little bit more, potentially can be added to the portfolio. I think relatively makes Tabcorp looks very attractive, I must say. Also give you that good exposure to lottery, and remember, Tabcorp's earnings being impacted, the wagering side being impacted by the COVID and things. So, there's potential for earning to improve there. And Tabcorp also is splitting out, its businesses. Usually for that sort of demerger, you do see a lot of value to be added. So, Tabcorp is much more attractive on that basis.
Yeah, so this one has obviously been a market darling for many, many years, and then now pulled back a little bit with the sort of them changing the way they're doing their model from more of a SaaS model, which is software as a service, and basically getting people to pay on a monthly basis instead of going for that sort of upfront fees and those kinds of things. So look, I think this one looks okay to me. I mean, I really like the whole idea of getting those managed services in there. And the upside scenario really assumes that there's growth in the retail, lottery and transactional value, which we expect, or the research note that I'm looking at, they expect a 25% year-on-year increase in those margins going forward. So that actually doesn't sound too bad. But on saying that, if they don't see that uptake, then this stock price could get around to about $13, and I think that's where you can see some really good support there. So for me, the scenario is a base case that I think it's okay here at the moment, but I'm a little bit confused about how the further re-rate is going to happen. So I'm just going to stay on the fence on this one and say it's a hold.
Hold for Jumbo Interactive, and just makes me think of the Powerball last night. I suppose none of us won. If we're all here.
Oh, that's right. I missed it.
There was 2 winners of, I think, 60 million apiece. One in Kalgoorlie and one, I think, in Coffs Harbour.
Oh, really?
And the story is he's going to buy himself a red sports car.
Good
Maybe he'll buy a few. I don't know. But yeah, lucky duck. All right, that already brings us to number 9. on the list, which is Stockland. Again, Stockland did report this week. SGP, this is for Xanthia. And so perhaps we can start just by talking about the company itself, its result, how you thought it fared, given everything that we hear about property and cognizant of the fact that it operates, in many different areas of the property market.
Yeah, look, Stockland had a good result. I think what's pleasing in the result was they managed to sell some retirement assets at book value, and we all know a lot of those property trust companies have been trading at a discount to its book value because market skepticism of whether they're really worth that much. So the fact they can sell at book value meant that portfolio actually looks pretty good. Look, the thing with Stockland is that it's like a third of its portfolio is retail shopping center, suburban shopping centers, and then a third is sort of offices and things, and then a third is residential property development. And so the retail, has a reopening thematic. It's coming back. It will be okay. And the offices, it's doing better. Next 12 months. And then it's the residential property development is doing really well. It's been doing well for some time. Yeah. So that's a bit where market will become a little bit challenged going forward because at this point of the cycle where interest rate, probably later this year was potentially going up, or whether we're following the New Zealand path of putting up rates quite quickly. Whatever it is, for property developer, it just seems to be at the peak cycle not peak cycle, but quite a strong cycle at this point. Yeah. It's more of a neutral for me. Gives a good dividend yield, but it's I think next 12 months there's you can make more money out of something else.
Yep. So they're able to increase their prices, which we saw in the results. So that's offsetting some of the cost pressures that are coming through because Stockland always seems to me, like many Australian property companies, it really is juggling a lot of balls at once.
Yeah. So I really like Stockland because of that diversification. So if you've got something like a Charter Hall REIT that's just doing offices or Dexus, that kind of thing, stay away from those because I still think that there's a lot to go on that sort of on that office side of things.
Well, you've seen, you're back in the city today, but a lot of these buildings are not full.
Still empty. So I think that's struggling. I really like the Goodman Groups of the world, which has just got the industrial parks. Okay, that's my favourite exposure in.
Is that narrative getting a bit old, though? I mean, it's done so well.
Yeah, no. I think absolutely you're going to have more and more of these larger companies coming into Australia that need large space to basically put their warehouses in there, and online's not slowing down. It's going to continue, and I still think, Goodman Group is a fantastic. While I think there's headwinds to persist within Stockland, I'm going to go ahead and say it's a buy. I think the valuation looks really, really attractive. And it's just sort of that guidance is at the sort of the top end of the range, which I'm really comfortable with. But I do like that resi side. I do like the retirement side. I think there's going to be a lot more of that going through, even though they're.
But didn't they offload their?
They sold some of it. They didn't sell all of it.
Yeah,
they didn't sell all of it. So that gets a bit of revaluation because they sold at book value. Yeah.
Yeah. So. The issue with any property trust is your property worth what you say in book value, so mark to market, and these guys are obviously doing that quite well. So I think it's a great one, pays a great little dividend, really, really comfortable with it. It's good for clients that are like sort of a steady as she goes kind of thing. And I usually mix that up with a VAP, which is the ETF property, if I've just got one, or I'd split it into Stockland and Goodman Group would be my two that I'd pick in that space.
I think Goodman Group, absolutely, and especially for underperformance. I think January was down almost like 17-18% in January. It's improved a little bit, but it reported a really strong number, and then it upgraded guidance again, so it's incredible momentum.
Yeah, and I'm just going by memory, so I'm probably wrong, but I remember that I had thought that the share price reaction would be overwhelmingly positive to Goodman, and I think it was just on the day. It wasn't sort of a really impressive share price reaction.
Yeah, look, I think it's just got caught in that week of people repricing the long bond yield, right? So people worry about inflation, worry about high interest rate, and then so all these growth stock company that deliver growth are all being sold off. But soon, I think we got bond yield moves a little bit because of the uncertainty, but we pretty much priced in most of the interest rate that's going to go up in the next 18 months. If anything, they might get pushed out if there's any slugginess, all of that. So I actually think these companies will start to outperform very, very soon, just simply how much they underperform the cyclicals.
Yeah, it's a fantastic business, Goodman, and will continue to be a fantastic business, and you can't go wrong.
And an exciting time to be in the market. It seems like lots of opportunities being thrown up. Let's go one more. This is for Eamon. Eamon, nice of you to send this in. This is Worley, W-O-R. Jun Bei, are you impressed with the company's move into more sustainable areas of the market? I know that some are.
I like the word. I like the renewable. That sounds good, and a lot of time it's enough
Nice
for
headline.
a lot of investors. That's right. It's quite funny, when people start grouping, because these days it's sort of ESG is so important that investors actually group those companies. So Worley are actually now being grouped into the ESG or clean and all of that because of the term. But for me, it's very early stage, and requires a lot of leap of faith of whether they could do it. They made big acquisitions in the past, not in this area, but they haven't really delivered to the expectations. So I think it's a leap of faith to think they could, what they could do with the renewable side. Ultimately, this business at this point of the cycle will be leveraged to, it's volatile, but will be leveraged to oil prices, because still quite a big part of the business is mining services for oil and gas industry. So, with the oil price over $100, you certainly feel, this business will start to do better soon. In the next 6 to 12 months, earning will look better, not so much renewable.
Yeah, it's kind of ironic that we're constantly talking about Worley in that context, because it has committed to spending $100 billion over, I think it's 3 years, to improve its capacity to service that sustainable, renewable area of the market. But it says that it'll be about 75% of the business within 5 years, only 32% right now. So ambitious targets.
Yeah, but it's forward facing, and oil and gas is a great business, and 85% of the world's energy needs are still done by fossil fuels. So it's in the right space, but it's been a really perennial sort of underperformer, disappointer. Constantly just sort of doing well. And look, the net PAT was 115, a little bit above consensus at 110. So look, I think cash flow was a little bit lower as well, but there was growth, and they were able to sort of generate that. But yeah, they are definitely hanging the hat on getting that sort of transition. The world has to spend some ridiculous amount of money to get to where they want to be in 2025, 2050, and all this kind of stuff. So they are in the right space. It's just going to be a leap of faith, I think. Now, also CIMIC getting the hock teeth, mopping up the last bits of that. It's a little bit of a long bow I'm about to draw here, but there's not that many sort of engineer or construction businesses left in the market. So I think it will start to see a little bit more money flowing into Worley. One, because it has that ESG. Two, it's in a nice space being oil and gas. But then, it's sort of the last one standing in that space. So, I'm going to stay with a buy on this one. I really do like it. And I like that forward-facing ESG side of things.
It was not a buy for you.
It's a hold for me.
It's a hold.
Not yet.
Okay.
I think, like you said, this is a just tough business. The reason they've been disappointing for years and years, because it's a tough business of managing people to go out to the rig and to service those rigs and things. That's a your own contract and fixed price contract. And then when things go wrong, things always go wrong, and then you gotta control. So it's actually a really tough business. And but once in a while they do well, and hopefully next 12 months, I think for the core business should be better, because given pricing is doing better and things, and that renewable, they have to have that in their business description. Otherwise, it will be sort of thrown into that fossil fuel group, the way investors just won't really.
But in the meantime, we're expecting to see some further investment in oil and gas to take advantage of these prices at this time.
Absolutely.
Well, that brings me maybe to a general question. So in this environment, we've heard from a lot of the big oil and gas producers in Australia. Is that an area of the market that you're invested in, would like to be invested in, or potentially take a bit of profit from, considering where prices are now?
So if you look at the oil price, you certainly feel it has done quite a lot of work, and it's just not sustainable at this price, because if it does, it will be a huge tax to the consumer globally. It's not likely to sustain. But for the oil equities, different. Oil, things like Santos and these businesses, share price actually hasn't rallied as much as the oil prices.
Woodside's done well.
Yeah,
Santos is just doing nothing, and I can't work out why.
So well. So it's almost becoming like a pair trade, right? Because Woodside's done so well, and Santos not happening. So I think for that particular one, I think there's a lot more room to go because the earnings will be an upgrade cycle. You always want to buy a company where earning gets upgraded. So I think both of these companies, in terms of share price, will do well. But it's just Woodside has outperformed Santos despite the big margin, something like 10%.
So Santos has traditionally been the one that is the most leveraged to the oil price, but they merged with Oil Search.
Yeah.
And I think there's a little bit of digestion going on with the assets in Alaska and Papua New Guinea. Now Santos is very used to Papua New Guinea. They're comfortable there. I think that Alaska side of things. So yeah, I'm just perplexed why Woodside's rallied so hard and Santos hasn't.
That confused me as well because the BHP Woodside stake will come out soon.
Correct.
So a lot of people were playing short Woodside
Correct.
and long BHP or long, the other oil.
Yeah.
So it really surprised me why it rallied because
Yeah.
BHP is going to, or give it, in specie distribution back to the
7 to
shareholder.
1, I think, is the ratio.
Yeah, so they will give it back, and
Yeah.
a lot of their investors don't want to hold the oil.
Correct.
That's the whole point of why they're splitting it
So
out.
I'd be shorting.
So they're going to sell it.
I'd be shorting Woodside June 30. Absolutely.
You'll be doing it now and then buy the Santos.
Well, maybe. But I absolutely agree with you that BHP shareholders are going to get a Woodside shares and they're going to go, not interested in this, and sell it. And then you're going to get this massive wave, June 30, you're going to get this wave of selling, like we saw with Soul Patts and Milton Corp, right? They took it over. Milton shareholders like, we don't want this, and you've seen the share price just get absolutely built. And I think that's exactly what's going to happen. Hey?
When was that?
Where or when?
When?
Soul took over Milton last year in November.
Oh, is it?
Yeah,
Oh, right, okay,
and so they merged, and then
okay.
the share price is you'll have a look at it, but share price has fallen because Milton shareholders don't want telco and
so
gas
they
and
just sell it,
coal and all that kind of stuff. So I think that's exactly what's going to happen with Woodside. Plus also most people will have Woodside in their portfolio, so then now they're going to become overweight Woodside in that sector. So you're going to see natural trimming of portfolios to bring it back to that 5% weighting in that oil and gas space. So I think Woodside's a short, closer to June 30.
Short now and buy Santos.
Short now by Santos. Well, you heard it here first. We've got our own little investment committee happening here on this Friday. I am loving it. Let me just summarize what we have learned over the past half hour in terms of the companies you're interested in. Thank goodness I had these guys here for Pexa. Not my finest moment. It's a buy from both of our guests, given particularly the opportunity that it really presents in the UK. Pilbara Minerals, both really questioning why the CEO is stepping down now. So cockroaches were discussed. At the end of the day, it was a wait from Adam. He prefers IGO. So does Jun Bei, incidentally, but it's a specky buy for her because, it's in the sort of right space. She's just a bit concerned about some of the production downgrades that they've had so far. Jumbo Interactive, it's too expensive for Jun Bei. She prefers Tab. It's okay for Adam. It's a hold for him. Stockland, look, Adam really likes it. It's a buy. It's diversified. Really does prefer Goodman Group, as does Jun Bei. She's pretty neutral on Stockland, says perhaps it's a bit of a peak of the cycle and it is diversified, but still not a buy for her. Worley is a buy for Adam. He likes the ESG lens. He knows what's coming down the traps, and oil and gas doing really well right now. Anyways, it's a hold though for Jun Bei. It's very early stages in terms of sustainability, the market that it will serve. Oil and gas will go well over the next few months, but look, it's a tough business to be in. And then we were just discussing Woodside and BHP. You'll have to go back and listen to it if you'd like to hear it again. Guys, thank you so much. It's so nice to see you both in studio. That was fun. Jun Bei Liu from Tribeca Investment Partners, Adam Dawes from Shaw Partners. Hope you guys have a great weekend. If there's any companies we didn't cover today you would like us to, you can email or you can tweet us, and you can check out that portfolio at ausbiz.co/portfolio. And don't go anywhere. Claude Walker from A Rich Life, he's a call regular. He's actually going to be joining me to interview one of the small cap stocks he's been watching. It was on his watch list pre-result. The result for Diverger came in today. He's going to help me interview the CEO. Stay with us.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Everyone who trades has a different style paired with a different strategy. So what do all traders have in common? Well, nobody gets it right 100% of the time. I used to be a trader, and for me the best chance of success comes from information. On The Trade, we delve into strategies, styles and skills of top traders. So join me live every weekday right here on ausbiz.
The Trade is brought to you by Markets.com, the world of financial markets your way.